it is definitely a lot to talk about. It felt a bit like a roller coaster ride, with most of it being the downward direction after, we did climb, quite a bit from June lows to where we had been recently, but a lot of volatility inducing news this past week. The biggest one, Jason, that we need to dive into a little bit is, the decision by the Fed for another 75 basis point rate increase, and also their post-rate increase press conference, where they really started to talk about a very, very hawkish tone, maybe even further out than what some folks in the markets were expecting to hear from them. So let's spend a little bit of time, just kind of dissecting that aspect first.
Yeah, and I think everyone's a bit fed up with the Fed at this point, but let's dive into it. And everyone had kind of anticipated that the Fed was going to raise rates by 75 basis points, but maybe what they didn't anticipate was that they would set the terminal Fed's fund rate for the end of this year at 425 to 450 basis points. That's 3 hikes more than the market had baked in just 1 month ago, and really what catalyzed that revaluation was the hot CPI print coupled with a really hawkish forward guidance. So I think we need to ask ourselves a couple of questions, and is the Fed overcorrecting its past policy error, moving too slowly to quench inflation last year? Are they now raising rates too rapidly? And the other thing is, how does this impact the relative attractiveness of asset classes? So in June, the FOMC was projecting real growth for 2022 and 2023 of close to 1.7% per year. They revised that down to 0.2% for 2022 and 1.2% for 2023. They also projected that the unemployment rate would be 3.7% in 2022 and 3.9% in 2023, which would represent a nominal increase in the number of people unemployed. Now that's changed. They're projecting an unemployment rate of 3.8% for this year, so a small pickup. And then next year, it's going up to 4.4%. And that's a lot of numbers there, but what does that really mean for the economy? 1.15 million Americans are expected to lose their jobs as a result of the Fed's tightening policy.
So if you think about why some of these indicators create this additional volatility, because like you said, heading into this Federal Reserve meeting, we pretty much were expecting a 75 basis point rate increase. And so people say, well, why in the world do we see this big market sell-off? And it's digesting some of that follow down or trickle down news. So wow, a much dramatically lower expectation for GDP growth, and therefore this whole concept of a soft landing sort of goes out the window. And, we start to project that into what that means in terms of number of people expected to be unemployed. So here we are talking about persistently strong employment, but forecast that into the future. Unemployment, well, that means reduced consumer spending, certainly. It's the snowball effect that occurs because we're going in the wrong direction at that point.
One important rule is called the Sahm rule, and it basically stipulates that over a 12-month period, if the unemployment rate increases by 0.5%, you are going to have a recession. And the Fed should be very familiar with this rule because they are the ones that published it in 2019. But here they are saying that the unemployment rate's going to increase by almost a full percentage point, and that next year growth is going to accelerate from 0.2% year over year to 1.2% year over year.
One of the reasons we talk so much about the Fed, and I like your opening, the people are fed up with the Fed, right? But one of the reasons we talk about that is a major potential cause of a bear market is a policy mistake by the Fed. And what we're trying to figure out right now is, are they correcting for a past policy mistake, or are we bracing for a future policy mistake?